Hello, hello. I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Friday morning. ELF Beauty or Elf Beauty, they either go by either name, I think. Ringing the bell at the New York Stock Exchange, BCB Investment Corp getting things underway at the NASDAQ. The hidden messages from the jobs report, there are a lot here, folks. Lots to unpack. The U.S. economy created a mere 22,000 jobs in August, badly missing economists' estimates for about 75,000 and continuing a stretch of weakness in the jobs market. Jobs figures for June and July were revised down by a total of 21,000 jobs. Blame tariffs from President Trump sowing the seeds of uncertainty amongst hiring managers, or AI playing the role of bulldozer through offices. The reality is, the job market has cooled, and that has implications for investors, perhaps a lot of them. All right, let's get more context on the disappointing jobs report for August. I want to send this over to Yahoo Finance Jen Schomburger in D.C. for a chat with the U.S. Labor Secretary. Jen.
Thanks so much, Brian. I'm joined now by Labor Secretary Lori Chavez-DeRemer. So great to see you. Thank you so much for joining me.
Of course, glad to be here. It's a beautiful day in D.C.
It is a beautiful day here at the White House. Weaker jobs report, though, across the board. We saw job growth in June turn negative, so we've seen now 3 months of slower growth. What's going on here?
Well, we're still in the positive. Almost 500,000 new jobs that the president has created. He's done his job. The president is doing a wonderful job with the trade talks, with the tariff talks. Tariffs are working. Congress did their job by passing the working families tax cuts. You know who has not done their job? The Fed. Jerome Powell needs to do his job and cut those interest rates now. What is he waiting for? You know, 2016, the president was correct. 2020, the president's correct, and he's correct today. It's time for all of who can assist the American people in getting this economy growing, and he's not doing his job.
Fed does have a meeting on September 17th. Are you looking for 50 basis point rate cut here, sort of a catch-up rate cut as opposed to 25 basis points?
Well, while I'm not the economist, I can tell you this. If he doesn't cut those rates, the American people will continue to suffer. You know, the companies are investing trillions of dollars into the economy and into their workforce and into their businesses. The American people, I mean, think about this. Wages have gone up, unemployment has held steady. We're seeing, again, the investments in the American worker. Everything that the Department of Labor is doing is to invest in reskilling and upskilling, and we need that help because why? Because cheaper dollars for the American business to invest in their workforce is not happening. And why he's waiting is, it boggles my mind why, he knows the data, he knows how important this is, and if it's a political move, it's nonsense. He needs to go ahead and move forward and cut those rates.
You mentioned tariffs. We know that the Fed has been watching the impact of tariffs on hiring, and we've heard anecdotally some employers who have been in a holding pattern. Do you think that that has had an impact on, over the past 3 months, what we've seen in the job market data? Could we see a rebound? And adding on to that, last night we heard from President Trump, who said we should really be paying attention to job growth into 2026 because of the groundwork that has been laid by his policies, that we could really see a boom next year.
Yeah, policies take time. I mean, that's the beauty of it. We knew that what the Biden administration had created. We understood that he was, these numbers for the federal government, 100,000 jobs have been cut from the federal government jobs, but private sector jobs have gone up. That takes time and that takes policy work. It's taken the president to understand that, tariff talks, leveling the playing field for the American worker and American business mattered, and he's been solid and masterful at doing that. Look at the dollars that have been received with tariffs. That's important to the American economy and the trade deficit. So he's doing his part. And again, look at Congress, how long it has taken them to decide that the Working Families Tax Cut Act is so important to the American people, and they finally got it done. It's going to be the biggest piece of legislation that they could have done, and that's going to finally kick in and help the American people. And again, that last leg of the stool, interest rates. Cut those interest rates so that there's a solid foundation for these businesses to grow, and then we'll see these numbers continue to tick up. I mean, still, 500,000 new jobs is great for this country. Statistically, the job market really didn't change, but we want it to grow and we want more investment. So I can tell you this, the president's doing his job, the Department of Labor is doing their job, making sure that the workforce is ready to go, and we're going to keep looking at the Fed to do their job.
Do you think we're looking at a lower, what economists call break-even rate, because we're seeing lower immigration in this country? In other words, we don't need to create as many jobs to keep up with population growth as a result?
Well, what we've seen is native-born workers. I mean, think about all the net positive jobs have been to native-born workers here. That's the America First policies that the president wanted. Of course, as we've secured the border and people have returned to their home countries, we have less people, but we now want American workers to be at the foremost, and the primary pinnacle of everything I do at the Department of Labor is through the lens of the American workforce.
Last jobs report, the president fired BLS Commissioner Erica McIntyre. He alleged the jobs numbers had been manipulated or rigged. Are this morning's jobs numbers trustworthy?
Well, we don't have somebody in that position yet. They have to still be confirmed and go through the process. But here's what the American people want. They want transparency, they want accurate data, and that is not what was happening over time. I can tell you the Biden administration, who knows what they did with inflating those numbers, but right now, the American people is where the president is leaning in. He wants to see the accurate data reports. That's what's important. Markets move because of these numbers. Everybody makes a move based on the numbers that come out. If they're not accurate, then what are we doing for the American people? We're not helping them. And that's the transparency that the president promised that he would deliver to them.
To your point, we've continued to see very large revisions, not just under this administration, but previous administrations. This has been ongoing for some time, and there have been question marks around data collection from the Bureau of Labor Statistics for some time. We know that the survey that you guys conduct, you give firms 3 months to answer. So what can be done, for instance, to get a faster response so that firms are responding in month 1 as opposed to month 3, so we're not seeing so much volatility in the data? What other changes could be done along those lines?
Well, when the new commissioner is confirmed, that's the key, the modernization of the systems themselves. For so long, a lot of these surveys are done on the phone. People are not answering. Look at the summer. Kids are back in school. There's a lot of various reasons why those numbers can move along. But we want the most accurate data points, and I think that that's what they're going to offer. So that's what the American people want. It's 2025. You mean to tell me we can't get accurate data, real-time data oftentimes? We shouldn't have to wait 3 months and then do these revisions that seem that they change the markets. And that's why, possibly, with the Fed not lowering interest rates before because they believe in a jobs report that the Biden administration had put out, we need to make sure we have accurate data for the American people.
And really quick before I let you go, I know you're short on time. The president signed an executive order a couple weeks ago that lays the groundwork for inclusion of alternative assets like crypto, private equity into 401ks. That order has been now directed to you for review for fiduciary guidance. How soon could we see guidance on that so that people can invest and have those options?
Right. Well, we already rolled back the Biden era rule for this reason. We do not believe that the Department of Labor should put their thumb on the scale. This is between the fiduciary and the investor. And that's what the president's asking for is, again, more flexibility and them working together and determining that. So as we move through the regulatory agenda, which was released yesterday, we'll move down that path. But that's what the president is wanting. He wants the flexibility so that everyday Americans have the opportunity to invest where they want to invest and that it's level across the playing field. So we're going to continue to move through that regulatory agenda. Have the input by the professionals. But again, those type of decisions should be made between the fiduciary and their investor.
Madam Secretary, thank you so much as always for your insight. So appreciate it.
Thank you so much. Great to be here.
We'll see you next month.
All right, take care.
Sozzi, I'll send it back to you in New York.
All right, really enjoyed that interview. Thanks so much, Jen. I should mention too, the markets opening at intraday highs. You're still seeing that strength. I think as investors bet on a potential rate cut after this absolutely dismal jobs report and those downward revisions to prior month's jobs. Now, our Powerhouse lineup continues on this jobs report Friday. Straight ahead, Goldman Sachs is out with an important call on AI stocks ahead of its big tech and media conference next week. Goldman Sachs tech analyst Eric Sheridan is here for insight on both. And we are moments away from talking to Joe Davis. We'll get his thoughts on this jobs report. He is from Vanguard. Markets brushing off today's big non-farm payrolls miss. The U.S. adding just 22,000 jobs instead of the 75,000 economists on the street were expecting. I want to welcome on Joe Davis, who is Global Chief Economist, head of the Investment Strategy Group at Vanguard. Joe, I thank you for being here. I mean, you are much needed right now. I'm not sure if you were able to see the Labor Secretary on with our Jen Schomburger, but she is putting full blame on the Federal Reserve not cutting rates sooner for this horrible jobs report. Should all the blame be on the Fed, or should it be evenly split between the Fed and the White House, or should it all be on the White House?
Well, I think we've clearly seen stall speed in the labor market. We're not seeing firings, but we certainly see the pullback from employers hiring. We were actually somewhat perplexed at the beginning of the summer why we weren't seeing more of a deceleration, given the policy uncertainty, some of them tied to the tariffs, for sure. So we were expecting a slowdown. We're clearly seeing it now. And so I think that's been an underappreciated factor. And so really now the debate is what changes we'll see in Federal Reserve policy, given in the weakening of the labor market.
But are tariffs more to blame here, you think?
Well, again, there's a constellation of forces here. I wish I could give a simple answer, but it's actually not that simple. I mean, we have a Federal Reserve that has been restrictive, but we also have inflation that's above 2%. We have had some uncertainty, profound uncertainty from the other policy side, particularly with respect to tariffs. And we're seeing now, I think, some evidence of that bleeding into the labor market. And then finally, we've had a slowdown in labor supply. And you see that, which is why some economists, if they're on the show, would say that the break-even rate for so-called full employment is lower, probably about half the rate it was just several months ago. So you have supply and demand factors all influencing the labor market at the same time. And so it's not as simple as trying to assess one factor for the slowdown.
We're already starting to hear murmurs of this. I'm looking at my inbox with the notes I'm getting from your many peers on the street. Yes. The worries that we are in a recession. Not only did we have the jobs miss here, you had now negative jobs for, I believe it was June. June now, yes. Minus 13,000 jobs. Are we in a recession?
No, and it's unlikely we will fall into recession in the next coming several months. I mean, I think we're in a little bit of a bizarro world with respect to the signals in the labor market. Because again, we've had a slowdown in the labor supply. The break even to keep unemployment rate flat is well below 100,000. So you're already close to zero, that sort of negative print, so to speak. We saw that in June, but I would characterize it as stall speed. If we were heading into recession, we would start to see a more material rise in firings, not just a stalling in the hiring rate. You would also see wage growth slowing. In fact, it's still remaining steady. So again, that's not to say that those couldn't change, but that's certainly not our expectation.
Fed decision, Joe, September 17th. Does the Fed uncork the bazooka in the form of a jumbo 50 basis point rate cut, or a jumbo cut, as everybody calls it?
Well, our baseline is 25. I think with today's report, 50 basis points will be discussed, and I think that will be the debate, is some of those points I just mentioned. Those that would want to go more aggressive at 50 would assume that we're going to see, further worsening. But I think there will be a even debate, and others will point to the points I just mentioned, that we don't have an uptick in firings, and we have wage growth that's hanging in there. And so you look at the corporate earnings pictures, and you look at the GDP numbers and so forth, that still points to me of 25 basis points, and the Fed continuing to monitor. I would be surprised at this stage that they would go with 50, but I think it will be discussed in the room.
How do you think the market would read it if the Fed does come out with a 50 basis point rate cut?
My inclination would be, at first risk assets would react positively. However, if we would give it 3, 5, 14 days, it may be negative, because there's always that risk of the market saying, hey, what does the Federal Reserve know that we don't know, and perhaps anticipating further weakening. So again, I think it will be, if they would go 50, I think that would suggest to me that they're having some concerns that we're going to see a slowdown more in demand, not just on the supply side. But again, that's not our baseline.
I put out a post early this morning, right after the jobs numbers hit, Joe, suggesting that really this report gave us our first taste of how AI is reshaping the labor market. I talked to a lot of CEOs, and they tell me privately, off camera or over dinner, lunch, wherever we may meet, that their entire back offices are now being eviscerated because of AI, and they're okay with it because it boosts their profits. Is this report suggesting that we're getting a taste of AI's impact on labor?
Well, I don't think you can. It's not very strong in the report. I mean, I think you'd be stretched to find that. Again, we've done 7 years of research on the impact of AI, and it will have a material impact, both positive and negative, on the labor market. And that's going to be 3 or 4 years in the making. That said, I wouldn't look at this number as evidence of AI is replacing a lot of human work. And in fact, even reports out of the New York Fed and some of the research that recently done comes to the same conclusion I would. So again, there will be disruption coming, but I think it's still in its very early stages.
Are you of the viewpoint, Joe, that AI is going to be good for the economy? I mean, it's going to drive productivity and it's going to drive growth longer term.
Net, it should be positive. That's what our focus has been over the next 4 or 5 years. But let me also be clear, with those positive impacts on growth, there's always disruption, and so you're going to see pushes on automation in 15 or 20% of the job fields out there. We've been looking at this for some time. You're going to have more augmentation, or what I would call I get better at my job rather than complete substitution. But there are going to be fields that will see the substitution. That's one of the contributors to a higher bottom line and higher GDP growth. That has always been the case and likely be the case with AI.
Lastly, Joe, before we let you go, I'm surprised that the markets opened at records, and I get it. Markets are betting. Now we get a rate cut in September. Totally understand. But do you fade this rally and get a little more defensive on the view that the economy is souring quickly than perhaps the broader market reflects?
Well, listen, I think stocks generally always like lower interest rates. It can boost discount. It boosts the discount multiples, but it's going to come through now the fundamentals. It's going to be if part of the slowdown in the labor market is really a rolling over in demand. We think it's more supply related at the moment. Then you're going to see, I think, a questioning of just the stock market, because that would infer that maybe the earnings and revenues, some of that's in jeopardy. Again, that's not our baseline. We see growth holding up, but that's going to be the push and pull probably for the next month or two.
You delivered when we needed you. Joe Davis, always good to see you. Really appreciate it. Have a good weekend.
You too.
All right, Goldman Sachs is sounding a little more cautious on the hot AI trade. A new note out today, in large part citing valuations. This is the investment bank gears up for the start of its big annual Communacopia Tech and Media Conference next week. I'll be out. I'm so psyched. Goldman Sachs' Eric Sheridan is here with me now. Eric, always nice to get some time with you. I want to go into this AI note your team's put out. But off a jobs report, let's just start there. Off a disappointing jobs report like this, how does it impact your thinking on some of the large cap tech names that you cover, whether it's a Meta, Alphabet, you name it?
Well, I think there's a couple things around the labor market that impact the technology field. Number one, most of the companies I cover continue to be balancing legacy operating cost efficiencies with the need to reinvest in the forward AI curve over the next 3 to 5 years. So you have sort of a push and pull, the way these companies talk about legacy costs and forward investments that can have an impact on employment numbers. I mean, most of the companies I cover have had low to no net employee growth over the last 6 to 8 quarters as they've realigned their organizations for where they're going over the longer term with respect to AI. It's sort of pulling OPEX out of the business model with an eye towards putting that capital back into capital expenditures that go toward the infrastructure layer.
Really enjoyed your team's AI note this morning. I believe it was by Ryan Hammond and a very large team doing work on this. Sounding the alarm a bit on AI stock valuations. And I'm glad your team brought this up because we saw large sell-offs this week at Salesforce, Figma, C3I. After earnings, they were okay, but they didn't blow anybody away. Conference calls were okay. Outlooks were so-so. Should investors be concerned about AI valuations at these levels, and why so?
Well, you and I have talked about this before, Brian, but this trade is very nonlinear and volatile in nature. So, when you go from the advent of the idea, when ChatGPT came to the forefront in November 22, to building out the infrastructure layer, to eventually having to build out the application layer of AI, it is not a straight line. And I think what we're seeing right now with AI is that we are clearly moving from a infrastructure layer investment theme towards an application theme. And we are seeing differences between how the applications of AI are deployed by consumers and by enterprises. Enterprises have to operate within strict budget requirements, and you also run into some friction on the employee side with respect to how they use AI in their own individual workflows. We see when you look at consumer AI that people are much more likely to adopt AI in their consumer computing habits than their enterprise computing habits because they see less potential for that to impact their own earnings power, to be frank. And I think at the end of the day, you're seeing very different skews of how AI is being adopted between consumers and enterprises.
Eric, I'm not sure if you saw this, that the tech meeting dinner last night, the President Trump, it was just the optics were amazing to me. You have Mark Zuckerberg over at Meta sitting next to President Trump and Bill Gates on the other side. It's fascinating theater if you're in media and you happen to cover stocks. Nonetheless, you cover Meta. You've been bullish on Meta shares. Zuckerberg said last night at dinner they plan to invest $600 billion in AI-related CapEx in the U.S., I believe, through 2028. Is that too much in your view?
Well, it is a greater dollar amount than we have in our financial projections today. Now, the nuance in that is you don't know from the outside looking in how much of these investments are going to be made by Meta themselves and how many of them may be made by third parties, such as private equity firms and private credit and data center companies away from the profit and loss statement of Meta. So I think there's a lot of large numbers being thrown out, a couple of $1 trillion before the end of the decade, hundreds of billions of dollars by individual companies. I think the devil is somewhat in the details of how much of this is actually going to end up on the financials of any one given company, as opposed to elements of private equity, JVs, partnerships. I think there's a lot of that's still to be sorted out.
Is the growth in Meta's businesses, Eric, whether it's Facebook, Instagram, or even WhatsApp, are they supportive of a $600 billion investment in AI CapEx? I'm trying to figure out what's the next growth catalyst for each of those platforms.
Yeah, well, there's a couple of growth platforms at Meta that we would highlight. You know, the deployment of AI into advertising systems is an area where you can actually today see real benefits of AI driving faster revenue growth. So we wrote a note a couple of months ago talking about how AI can disrupt existing advertising profit pools and highlighted Meta along with Alphabet and Pinterest and AppLovin as companies that could benefit from that broader secular theme, and identified hundreds of billions of dollars of existing industry profit pools that could move towards the digital advertising landscape. Last quarter alone, deploying more AI into their content recommendation engine resulted in a mid-single-digit increase sequentially in engagement, meaning folks like you and I used Instagram more because Instagram's content recommendation engine was being better run through a mixture of AI and machine learning. And there are elements of that we think remain underappreciated that could sustain high teens or 20% growth for longer.
Lastly, Eric, Google's antitrust case effectively over. Is it off to the races for that stock? Because as you and I know, that stock has been trading at a discount to the broader S&P 500 for some time, in large part because of this case.
Yeah, so in a note the other day coming out of that ruling, what we articulated is that you could see Alphabet make a move now towards a market multiple. It does trade around 3 to 4 points below a market multiple today on 2026 and 2027 earnings, depending on how far out in terms of operating estimates you want to use for your valuation metrics. That could push us towards an upside node. We've articulated an upside node in the stock closer to $300 a share against our price target, which is roughly where it's trading today. And as people get more comfortable with the mixture of assets inside Alphabet, what's been interesting about this ruling, Brian, is that the ruling acted as an overhang on the multiple. But if you actually go out and talk to investors like I do every day, most of them want to own Google Cloud, YouTube, and Waymo as exposure to those businesses, but the overhang was on search. With the overhang lifting around search, you do wonder if you end up with a full re-rating of this asset portfolio, as we've talked about in some of our prior notes.
All right, we'll let you go. I know you got a big week, probably a big weekend of prep ahead of Communicopia. Looking forward to seeing you there. Looking forward to being at that conference. Thanks, Eric. Appreciate it.
Take care, Brian. See you out there.
All right, and tune in this coming Monday and Tuesday as I will be live from the Goldman Sachs Communicopia Conference in San Francisco. I assure you, some very big interviews on tap. How do I know? Because I've been helping to plan this. Coming up, Yahoo Finance Market Catalyst. We bring you the news behind the market moves for the trading day. You won't want to miss it. We'll dive more into that disappointing jobs report.